Hi, welcome to First Funders. This is Amir Virani. Our interview today is with Rajiv Bala, General Partner at Clutch VC, a pre-seed and seed stage fund based in Austin focused on Texas B2B software companies. We wanted to have Rajiv on because we've gotten listener requests to hear more from folks outside the Silicon Valley ecosystem. Many angels and GPs ask us whether it's even feasible to get in the startup investing game if you're not connected to the San Francisco Bay Area and the venture capital firms here. Meanwhile, Shahroz and I are both big believers in the power of entrepreneurship and company building anywhere in the world. And I'm from Texas, so I think it's the best. I know many smart people there, but I also think there's a distinct founder go-for-broke mindset you only see here in California, and I haven't really figured out whether that means you should try to build a company elsewhere. With Rajiv, I think you're going to hear more about this difference, as well as how he thinks about outcomes and founders when you have a little bit more time with folks before making an investing decision. Here's our interview with Rajiv Bala of Clutch VC. Welcome to First Funders. Our guest today is Rajiv Bala at Clutch VC, which is based in Texas. I'll mention real quickly how I know Rajiv. He was one of my students when I was a TA senior year at Rice University in ELEC 241, which is the Intro to Electrical Engineering. And so we got to know each other there, and then we both went off, and I would keep hearing about him as a person who was a couple years behind me. And then we reconnected whenever he ended up being in venture capital while I was a partner at Felicis Ventures. And we've stayed in touch since then, and I've heard lots of exciting things about what he's been working on. He's now working on his own firm, and we're happy to have him here today.
Thanks for having me.
So Rajiv, we'd love to hear about your journey into investing, right? People usually do something before they go into venture capital. And so we'd love to hear where you started and how you ended up deciding that this was the place for you.
Yeah, we were both at Rice University together, studying electrical engineering. And after I graduated, I went to be a applications engineer at Texas Instruments. They have a group where it's an incubator group where they throw a few engineers and a business person at a problem and try to go build a business around that. So that was the group that I ended up in digital radio. So we built a business out of that. And then I moved over to the product and marketing side, where I was a product manager, marketing manager focused on automotive infotainment. So we had a chipset and some software that we were selling into tier 2 automotive manufacturers. We built that into quite a business there. And then all of my customers went bankrupt. So Visteon, Delphi, all of the American automotive manufacturers in 2006, 2007. So I decided that was a good time to go back to business school and decided to go to the University of Texas. One, because I knew I wanted to stay in Texas long term. And two, they have a program where you can intern at venture funds. And I was thinking I'll go get some exposure to that and then go be a product person at startups, but ended up through that program interning and then ultimately joining a firm called S3 Ventures in 2008. And I ended up spending a decade there learning the venture business and growing quite a bit. When I first started, we had a $20 million fund and there were two of us and a venture partner. And by the time I left, we had raised $500 million across 6 funds. We had gone from a $20 million fund to a $200 million fund. I think we had 8 investment professionals. Grew up quite a bit during that process. That's where I learned the venture business.
I'll ask the question that my wife often asks me, why the loyalty to Texas?
One, I believe that there's just tremendous opportunity here. It's 10% of US population, 10% of GDP. There's still only about 4% of venture capital that's deployed here. And there's a massive opportunity. But honestly, it was one of these things where I fell into it at first. I could have very easily moved to the Bay Area, but year after year, Texas just keeps getting, better and better to invest in. And post pandemic, we've hit this step function that makes it a really special place. I'm sure you guys know someone who's moved to Austin. Pretty much anyone I talk to knows someone who's moved to Austin, which is not the case 10 years ago when we were investing here. I would call someone in California and they'd say Texas and I get hung up on. So now it's a lot more, people are a lot more interested in it. I'll put it that way.
Wow. I'd love to jump in and hear a little bit more about the evolution of the ecosystem there. For me, even around the 2006 timeframe, probably closer to 2008, I started visiting other ecosystems all over the US. So there was Austin, Chicago, Boston, and then Toronto at the time there and London, and followed those ecosystems for the following 10 years myself through the work that I was doing at the time with Women 2.0. I was only driving by and getting to know the local VCs and the founders, and didn't necessarily plant my roots. I remained in the Bay. So I'm super curious for someone who stayed in one place for that period of time. Like, what is different now? What has shifted? What are you seeing and what keeps you bullish?
Yeah, as you guys know, the venture arcs are very long. And so if you go back to before the dot-com crash, even into the 70s and 80s, there's just a lot of activity in telecom and semiconductor when venture capital as an asset class became a thing. And we did pretty well. There's a lot of great semiconductor companies that came out of Texas, a lot of great telecom companies. And then after the dot-com crash, telecom semiconductor never recovered. And we had a lost decade where there was one firm that dominated called Austin Ventures, and they had a tremendous amount of success. They ended up raising some pretty large funds in the early 2000s. And that's when a lot of the current dominant funds started between 2005 and 2010. We all started with small funds. We all had a lot of success and have raised bigger and bigger funds. And so what I'm seeing is the cycle start again, where I see a tremendous opportunity in pre-seed and seed, which is why that's where I'm focusing now.
Yeah. And I was going to say, can you comment a bit about the shift in the rest of the ecosystem on the founder side, or a little bit more about what kinds of companies are coming out now, given post like semiconductor crash? Like, what can Texas be, or what is Texas becoming known for from venture side?
Yeah, it's interesting. Over the past, let's say 20 years, our legacy has been infrastructure, software, developer tools, cybersecurity, some of those verticals. But over the past few years, there's also been quite a bit of activity in marketplaces, vertical SaaS, even some consumer. And so when I'm fundraising from LPs, if I get exposure to Texas, what are the underlying sectors that I'm actually getting exposure to? And there's not a great answer because, we have a legacy of some of these sectors, but with the amount of people that have moved here in the past decade, there's one point where Austin was one of the largest cities for cybersecurity talent without any of those people working for Austin-based companies. And so you're starting to see some of that talent develop and companies form, and it's in a broad variety of sectors. But I don't know that we're like, if you're investing in New York, you get great fintech exposure. We just don't have a great story around that yet.
So I lived in Austin after leaving Rice for a couple of years, and they were trying to brand themselves as Silicon Hills back then. Right? This is like the early 2000s. And then I moved out here to Silicon Valley and realized, no, not even close. It's just a mindset that is very different. The people here are leaving and breathing startups, and they think that is the thing to do. So one question I have for you, Rajiv, is like, what do you think is the mindset down there, not just in Austin, but in all of Texas? Can you share how not just investors think about the startup ecosystem, as well as how the founders are operating? Like here, it's live or die, right? I'm working on this 80 hours a week, blah, 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 blah. Do you think that's different down there? What do you see?
I do think it's different. It is that when I go out to Silicon Valley, it is everything revolves around startups and building companies. And even if you go to the restaurant, like the next 10 tables are talking about the same thing. In Austin, and especially in Houston, Dallas, San Antonio, El Paso, anywhere else that you go in Texas, it is not like that. The reason that people move here is because it's a great place to live. It's a great place to raise a family, no taxes, and you can have a great life without having to spend a couple $1 million on a house. And so people come here because it's a great outdoor city. It's a lot of culture, great live music. It's a fun place to live, but at the expense of, you don't get people living and breathing startups 24/7 in the same density that you do in Silicon Valley.
Do you consider that a con, or do you think that's just different?
I think any geography that wants to be the next Silicon Valley is going to fail. And so we want to be the first Texas. We want to be the first Austin. And I think that we attract the type of talent that is looking for great work-life balance while also driving and creating some amazing companies and going to a cocktail party and not having to talk about your startup 24/7.
What do the LPs expect then? Because we have a standard operating playbook for startups with the Silicon Valley mindset, which is raising a certain amount of cash based on your industry and getting to an outcome within a certain amount of time. Is that playbook a little different? And our LPs, do they just acknowledge that there's a new playbook being written, particularly for this region?
Yes, I do think it's a different playbook. I think the playbook is actually, if you go back to Silicon Valley 20 years ago, it's the playbook that we use here and really in any geography outside of Silicon Valley. I think over the past 10, 15 years, there's become this mentality of you've got to be in unicorns. You've got to be in only $10 billion companies. And that's the only way to 5X a fund. There's plenty of funds in geographies outside of Silicon Valley that have 5 to 10X on purely sub $500 million exits, right? It is certainly a different way of investing than only trying to find the unicorns, right? It means that entry point matters. It means that your portfolio construction has to align with that. Your fund size has to align with that. But it's certainly a different mindset running a geographically focused strategy.
That is great. Thank you.
Can you share a little bit about how you're constructing your portfolio then? When we look back at some of the other guests who have been on, there's been a whole discussion of, I have a lot of money, and so I deploy more in order to maintain ownership. And there's other folks who say, I write smaller checks, so I have to diversify and spread it out a little bit more while still taking into account future pro rata considerations. What are you thinking about whenever you're developing the portfolio, when you're constructing the portfolio for Clutch?
I'm coming to the conclusion that you make your money on portfolio construction. And everything else that you do, trying to set your companies up for success, helping them along the way, helping them connect to other investors, helping them raise follow-on capital, getting the right person into the right spot at the right time. All of that is driving to help them hopefully catch luck at some point. But if you drive a broad enough portfolio, stay super disciplined about initial checks, follow-on checks, I think that's how I've come to approach this early stage investing.
So can you share some specifics on that? What does that mean for your check sizes, the valuations you're dealing with, and like the stage of company? And maybe this is also a good place to just tell us about Clutch specifically, since we didn't talk about it in the intro.
Yeah. So there have been a handful of times in my venture investing career where I thought I had a sure thing. There's no way this company can lose. And if you think you have a sure thing, you should plow as much money into it as you can. And specifically, this is probably a decade ago, I had an opportunity to put some personal capital into a portfolio company that I thought was no chance it would fail. I didn't do it at the time, but ultimately what ended up happening to that company is it ran into some macro tailwinds and ultimately couldn't recover. And a company that was doing 20 plus million of revenue dropped down to sub 2 of revenue. And that was a huge lesson for me in that even if you believe that it could be a sure thing and you want to double down on your winners and you want to throw more capital into companies that you think are going to work, you still have to get back into that mindset of, does this align with my portfolio construction? Because you can get overexposed to a company that ultimately all of these things are still startups and they can all fail at any time. That makes sense. Does that answer the question?
Yeah, absolutely.
Yeah.
Diversification is a strategy for a good reason. It works, right? I think you're very right about that. I think it's easy to believe and know in that or feel a belief in that moment, but we all don't know what the future holds as investors. And we all are always humbled when things evolve.
And you want to believe, right? Like you've been working with these people for years and years and you've seen them in like the depths of despair and the highest highs. And you're like, all right, they finally got it. We're finally going to make a ton of money together, but that may not be the case.
Yeah, absolutely.
We're talking about this as part of your location as well, right? You keep referencing Austin, but there are other cities in Texas as well. It sounds like one of your theses is just to focus on Texas investing. Could you share like how you're thinking about just the geography itself? Do you worry about Houston and Dallas and San Antonio and El Paso, or is it more Austin 90% of the time? And if someone else emails you, great.
No, we're certainly spending a lot of time in Houston, Dallas, and San Antonio as well. El Paso, a little bit less, although we've looked at a handful of deals out of El Paso, Midland. There's opportunity all over the state, but because we're primarily investing in software, a lot of that activity happens in Austin. The way that we think about talent and great ideas are coming from all these cities. But if you're going to scale a really big company in even Houston or Dallas, where there's tons more people, almost 10x more people than there are in Central Texas, you still have to find the talent that values private company stock and that's willing to get out of their great oil and gas job to take a risk on what could be ultimately a failure. And so culturally, it's a lot easier in Austin to really scale a business, although that's changing quite a bit in Houston, Dallas. And I think there's going to be lots of opportunity in both of those cities, and as well as San Antonio, El Paso, Midland, you name it.
So this leads to a question that we got from a lot of listeners before you came on. You are not in Silicon Valley. You're in Texas, which is still a hotbed, but it's definitely lower tier than Silicon Valley or New York. How are you finding companies? How are you finding people to pump money, like teams to put money into? This is like in Silicon Valley, you can go to a coffee shop and you'll hear people talking about their startup while drinking a cup of coffee. And meanwhile, you're talking about cities that are literally hundreds of miles apart and trying to find all the deal flow you can there. So how are you doing it? How are you reaching out to folks? How are you finding companies that might be interesting when they're that early stage? They may not even have a website or revenue.
I've been doing this now in Austin for about 16 years, my partner for 30. So most of the venture-backed companies over the past 20 years have touched one of us that are coming out of Texas. And the first thing you do if you are an early stage company, if you're a first time founder and you want to go raise venture capital, oftentimes you go find someone who has been in a venture-backed company before. And most of those people who have been around Texas for a while know who we are. And so almost all of our deal flow is network or other investors. We also have, I think it's 11 later stage investors that are investors in our fund. So we get a significant amount of deal flow from those funds that's like, it's just a little bit too early for us. Why don't you go talk to the guys at Clutch? So we try to set, we're not doing a lot of inbound in region stuff yet, although that we would like to. It's primarily setting up the pieces and the deal flow comes to us in that way.
Okay, let's talk a little bit about why. So here you are running this fund. You took the leap on your own, which is not an easy task. What is your why for investing? What is your purpose in all of this?
I love working with founders. That is really what it comes down to, is there's this point after companies have started, they're maybe getting their first customer, their first couple of customers, and they have to figure out, how do I turn this into a business? How do I get the right help alongside me to really scale this into something big? And that point is what I love. Working with founders, it's super messy. A lot of times there's product iteration, which I love as a product guy. There's go-to-market iteration. No one figures it out the right way out of the gate. And so that's the stage that I just really love working with. And so ultimately, like, if I am successful at that part of the startup stage, it will create these ripple effects that have impact on people, on the economy, you name it. But really, ultimately, for me, it's about helping founders get through that stage.
So does that mean that you like to get on the board of companies at that super early stage and then you roll off as they solve all the problems that you find interesting?
Yeah, we will often get on the board. We don't have to. I view board seats as ultimately being able to implement negative control, like block something or do that. What I care about is positive control. I care about influence. I want the founders to listen to us. We have a certain point of view on how to build companies, and we want them to trust us to give them good advice on that. They can listen to it. They don't have to, but we want them to listen to it. They don't have to do what we say, but we would like them to hear what we have to say. And in those early stages, ultimately, if you do your job as an investor, in my opinion, as the company progresses, whether or not you maintain that board seat or stay on the board or roll off, if you're still the go-to that they call when they have an issue, then you still have that positive influence over the course of the life of the company.
As you suggest that it sounds like there's a Clutch playbook that you would like to follow, that you like to expose your founders to. Could you share a little bit about that with us? Because you're saying that there's a thing we like to see once you're working with someone. So what is that?
Yeah, ultimately, what I think our job is as seed investors is, and really Series A investors, and then it changes as you get to the Series B, Series C and beyond, but it's really all about how do I get a predictable business that can scale with capital. And if you get to that point by the time you're at the Series B, then it's all about just dumping capital onto it to help it really expand. So if the ultimate goal is predictability, it can take a number of paths to get there. It could be we need to really work on the go-to-market model and get a super experienced enterprise salesperson in there. It could be we need to iterate on landing pages and figure out what the right messaging is. It could be that, hey, we don't even have the right product. We need to make sure that what we have is what people want to buy. And so I wouldn't say there's a standard playbook for that period. Get a company operating in a predictable manner. You do have to have a certain element of the can you rinse and repeat? And that's where we try to get companies over the course of the first year or two of investment.
Yeah, sounds a lot of the process of getting to product market fit, right?
Yeah, exactly.
Yeah, great. I love that. So let's now talk about a time way back when. So you came out of, I think, business school and joined a venture fund. Would love to hear, and maybe that wasn't the first time, but what was the first investment you did? And what did you learn from that experience?
Yeah, the first investment that we made when I was at my old firm was in a company called Furnace Software. It was in the DevOps space. We invested when it was very early, what you would now call a pre-seed company. At the time, it was called Series A. It just started to work. We sold it 18 months later to BMC for a great outcome, almost fully returned our fund, a massive success. And I was like, man, this venture thing is easy. Little did I know, everything after that was really hard. But it was super interesting because seeing that type of quick success early, what kind of showed me what was possible in this business. And they had an amazing team who we've gone on to invest in various iterations of those teams multiple times. The CEO of that company is now coaching one of my portfolio company CEOs right now. And so it was just a really fun experience to see from cradle to grave in 18 months when I first started in the venture business.
And when you reflect on that journey, at that moment when you decided to put that investment, what did you see that said to you, it's time to put a check in? And could you foreshadow the outcome that did happen?
Absolutely not. There takes a little bit of luck in this business. And I think that one, we just happened to catch it at the right time. It was a time where I was very early in my venture career. So I hadn't really developed the pattern recognition or any of that stuff yet. But it was a product that people clearly needed. It was a new market. There's development and IT, and there's this broken handoff that was happening in between. And it was a part of the market that we felt like there really needed to be a solution in. And luckily other people agreed over time and needed to buy the business. Timing was interesting too, right? This is 2008, 2009. The world was falling apart. There were buyers for the product. We had no idea if there would be buyers for the business in any timely manner, but it ended up being right place, right time.
Can you give us the super short elevator pitch for what Furnace does or did?
You're taking me back, but it was basically for Java app deployment automation. When you were deploying a Java app to a Java app engine, there's a bunch of configuration that you had to do. It was all done manually. And if you made a mistake, there's no way to roll it back. And that's what this product did, is it managed the configurations for Java app engines and allowed you to basically manage those in a operational manner.
Given the background you described, and maybe of some of your teammates, that sounds pretty technical. How did you, as an early stage venture investor, vet something that sounds that technical? Like that, I think a lot of the listeners out there are saying like, I'm not technical. I just have money I want to deploy, or I'm a founder, but I'm not in the technical space. What was the process that led you to say, okay, this is worth writing a check for, this is worth actually investing in?
Yeah, this is a thing that I still both lean on and struggle with today. Being engineers early in our careers, learning how to build product. I learned how to build good product. I also learned how to build bad product. But at the end of the day, I am not really great at evaluating technology. There's plenty of people that I know that are way better than that. Even in the early stage investments that we make now, we often won't take technology risks. So we want to see it in someone's hand working. Now, that doesn't have to be paid. It doesn't have to be the final product, but we want to know that there's something sellable there before we invest. So we let the customers tell us, really.
Every venture capital firm I've talked to has some sort of deal memo they like to write. And there's a section that's usually about risks. So it sounds like one of these sections in risk for you is technology. Can you share with us what other types of risk you actively think about?
Absolutely. Team risk, we will never take. We want to believe in the team, the stage that we're investing. If we believe that they're not the right team to go execute, if they are maybe the great team to go execute, but they're not going to listen to us, we often won't do that deal. Market risk is one that when I was a Series B investor, I was not willing to take. At the pre-seed and seed stage, that almost is one of the best risks that you can take. And that's not to say that if the market will always win. I think there's a Kleiner or Perkins or somebody said an A team against a B market, the market will always win. But as a pre-seed seed stage investor, if you want to bet on the fact that a market will appear and will be massive, that's where I think you can drive some outsized returns. And that's some of the best wins that we've had, is betting on markets that don't exist yet, but that we believe have a really good chance of showing up in the short term.
Okay, so to summarize, the risks that you have top of mind are technology risks, team risks, and market risks.
And then deal or economic risk. That's another one where we are looking for enough ownership to where it can move the needle on a decent outcome. It can move the needle on the fund and the fund returns on a decent outcome. That rule is one that we are willing to break when the right opportunity comes along, but it is one that we take into account.
Given your fund size, what is your target ownership?
We want to be at least at about 5% ownership. Our typical check is a 500K check. So we can go up from that if there's certain dynamics, if it's a little bit of a later stage company, or if there's a higher price that we're just joining a syndicate. But we certainly want to at least own that 5%. If we can get up to 10%, great. That has to be oftentimes a lot earlier stage company, but that's where we want to be.
That makes me want to ask the question, for the companies that you look at, what is the band that you're seeing in terms of valuation right now?
It's all over the map, but in general, I would say that valuations tend to be 30 to 40% lower in the non-Silicon Valley markets than they are in Silicon Valley. And we are usually looking at companies in the 10 or sub 10 range. We've done a few up to 15, but if it starts to get into the 20s, then usually it gets away from us.
We've offline spoken about the difference in traction for early stage as well, though, right? This is not true, but a lot of people think that the typical Silicon Valley raise at pre-seed is, oh, I had a slide deck. I didn't even have a product at all, right? That's not true. People think that's true, but it's not true.
Right.
It's true once in a while, but not often. But I think comparing it to what you say you've experienced, it'd be helpful for the audience to know, what does a pre-seed company look like when they're coming to you and saying, I'm looking for my first true funder, right? Not just friends and family, but beyond that. What are they coming to you with?
Usually it's product built, something that's sellable. It's usually in the hands of customers, paid or unpaid. And that's where we will really engage $500,000 check into $1 million to $2 million round. That's really our sweet spot. Post product, pre-revenue, early revenue. With teams that we backed in the past or other folks that we know, we will invest on a slide deck. That's typically a smaller check for us, $250K. But for us, that's a bet on the team. And then usually if it's getting to $500,000 plus of ARR and they're raising a true seed round, 3 to 5 million, we're focusing earlier stage in that.
So you've definitely got a delineation in your head for a difference between pre-seed and seed compared to some of our other investors. It sounds like there's both something around the team and product, what's been accomplished there, and then also the amount raised and asked for and the valuation asked for.
Yeah, usually it's, I would say the difference for us between pre-seed and seed is pre-seed, $1 million to $2 million round, early revenue, pre-revenue, but close to commercialization. Seed tends to be into commercialization, maybe not figured out the repeatable sales process yet, but enough traction where they can go raise a $3 to $5 million round.
Thanks for sharing the information about Furnace and your first investment with us. So why don't we move on to the next question we'd like to ask, right? Which is about your worst investment or like a standout challenging moment that brought you important lessons. So this is probably going to be further in your career. What's something that sticks out to you as your worst lesson or investment?
Yeah. Anytime someone asks me this question, it's the same one. It has been for a long time because it happened almost immediately on the heels of our great success. It was a company that we invested in late 2009, early 2010. They had pulled some assets out of a defunct company, right? So this is maybe an interesting time to talk about that because we're starting to see some of those type of deals come back. Hey, this company didn't work, but there's great technology in it. We think that we can respin it and start a new thing and turn it into something. So it was pulling those assets out and creating a new company around it. It was in the internet telephony space. And we loved the idea. We thought that there was a really big head start that they were going to get from these assets. But ultimately, very quickly, actually, it became clear that we were not going to get product out the way that we thought we were going to get it out. And we had to restructure the company, and I ended up running it for a while, which if when the VCs have to step in and run it, shit has gone south. But for me, it's just incredibly impactful because it was early in my venture career. I had to step in and I had to lay off half the team on day one. And it's going through that and having to look people in the eye when you tell them you don't have a job anymore is a incredibly formative experience. And I'm glad that I was able to have that early in my venture career. I do see every once in a while young venture capitalists saying, we just cut a bunch of heads. And that disconnect between taking costs out of the business by firing people or laying them off and reducing burn by cutting their salary, disconnected from the viewing those people is an easy thing to do, especially early in your venture career. But having those things put together very solidly in my mind, I think creates a lot of empathy in what we do today.
Yeah, I can relate to that story. Wow, you're taking me back. I think I've forgotten about it, but I too had to go through this where we incubated an idea inside of Nike with a real founder and real employees, and we had real customers, and it clearly wasn't working, and it was time to shut it down. And I had to come in and do exactly what you did on day one, which was to lay off almost the entire team, including the co-founders. And so layer after layer, it's a really hard task, whether it's your company or not, to handle humans who've chosen to believe in something and expect some livelihood from it. So I can feel some empathy for you. And I think I've ignited some PTSD as well.
Yeah.
So thank you. Thank you for that.
From it is, I don't know that we're really going to take a look at companies that are pulling assets out of distress to restart companies, because what you think might be a technology at risk might actually just be an albatross.
Absolutely. You just never know what you're pulling off the shelf. I totally agree.
Yeah.
So you're going the direction I was going. I'd love to hear you reassess this then using your frame. So let's go through the list, right? So it seems like something was off with the technology risk. Can you share a little bit more about the learning there, or what was off? What was your misassessment?
This was during the period where a lot of internet telephony was transitioning from large CapEx into the software layer. And we miscalculated because we got actual things, boxes, internet telephony boxes out of this bankruptcy. And turns out that was the wrong path forward.
Yeah, this is definitely reminding me of another friend's company at that time as well. They bet on hardware when the bet was actually supposed to be on software. And
exactly.
We all use Zoom today. And that was the thing that won compared to the friend's company. How about the market risk? IP telephony. Everyone uses IP telephony. So what was wrong? Was there anything wrong there? Or do you feel like, no, that was great?
We were so right on the market. So right. It was almost a combination between Twilio and GroupMe, both of which went on to be massive successes, but we just didn't have the right tech.
And then how about the deal ownership? Did this sink the fund? What happened there? Or was this just the proper allocation and it was going to go to zero and it's fine. Everything else worked out?
Yeah, this was probably my first early lesson on portfolio management. We didn't have a ton of money in it. And so it was painful, and it was a great lesson early in my career, but it was a loss that we could stand at the fund.
All right. That's such a great story. And again, somehow you reignited some old memories because I was in the internet telephony space. I could never say that word when I was in it. 2000. Oh my gosh, what year was it? Yeah, same time frame. 2000, actually 2006 through 2009,
Oh,
something like that. I worked at two venture-backed companies in the space. And it was the iPhone was coming out. I just remember all of that. Like, it was such a big shift in the industry. Thanks again for the story. So let's talk a little bit about something that's a little more positive. Let's shift our energy into, so far, is there an investment that you are incredibly proud of and where hopefully you've realized some sort of outcome? We'd love to hear about what that was. Again, what lessons you had from making that investment. How long did it take? The full story would be great.
okay. For a couple of years, I was doing deal by deal investing. We were putting together SPVs and primarily leading rounds. And one of those deals was a company called Converse Now. They are a voice AI for food ordering company. I originally met them in 2019, Q1, I believe, because in 2014, I had looked at a company that was in the robotic space. Ultimately, it wasn't a fit for us and we passed on it. But I guess those founders had a good experience with me. And so they referred this company over to me. And so originally they had a voice platform that was going after a different market. And I was like, I really like these founders. I really like the technology. I just don't like that end market. So we spent almost a year together, over the course of which they ended up finding this market around food ordering. And to your point earlier about technology risk, I was like, man, I think this is really cool, but there's no way I'm going to be able to tell if this is good tech or not. And so basically I told them they had one unpaid pizza location. And I said, if the franchise owner is willing to roll it out to the second store and pay for it, then I believe that the tech works well enough that we'll invest. That's what they did. And it started to work. We had our capital lined up in February of 2020. And then the world fell apart in March. And at the same time, my daughter was born February 20th. And so we were sitting here in April, not really sure if this thing was going to go, but we ended up cobbling together the syndicate and investing. And it's probably going to be the best investment of my career. Since then, Craft Ventures came in and did the A, Enlightened Hospitality Investments, which is Danny Meyer from Shake Shack's investment arm, did a round after that. And we're clearly the leaders in the space, thousands of locations with brands. And it's in the NLP space, there's not a ton of real world applications, but food ordering is one that works and has real commercial traction. And so that company is doing really well, and we're super excited about it.
Can you share some of the brands they work with? Do I use Converse Now at my favorite place to go eat?
Yes, any Domino's location that has automated food ordering, Wingstop, a number of smaller brands that they work with that we're live with. I think it's several thousand locations of things in burgers, wings, pizza, sandwiches, Chinese food, you name it. They're all over the place.
I am so hungry now. So something you said really stuck with me, and I'm super curious. Craft Ventures led the next round, a San Francisco-based venture firm. Tell us more. Is it common that your breakouts end up being invested in late rounds by San Francisco-based venture funds, by Bay Area-based venture funds? Like, is there a trend across the portfolio that certain companies will continue to raise from the local geography and some will break out to other locations?
Yeah, I don't know that there's really a rhyme or reason to which ones go to the local firms, which ones go to the coastal firms, but especially over the past 5 years, the coastal firms are waking up to the opportunity in Austin. You look at a firm like Kraft, they've done a handful of deals here, Andreessen, Sequoia, Battery, you name it. We've had coastal investors coming here in the past. A lot of it's been from the East Coast, though. And so I think West Coast investors are starting to look at other geos and in particular Texas?
Yeah. Do they mostly come during South by Southwest?
There are a lot that come during South by. It was just last week. It was nuts. We ended up having an event here with 100 VCs that were in town.
Yeah.
Which
we hosted a brunch as well. And we saw everybody who we normally run into in the street in Austin.
Yeah, exactly. It's one of these things where the rest of the country comes and sits on Austin for a couple of days, which is a really good thing. I like it.
So I have a question for you about incentives, right? I could imagine that for you and the founders, getting a Silicon Valley or a New York firm involved might mean that their valuation is higher than if they had stuck around and just went with someone in Texas. So do you feel like that game is being played, that you're hoping to be a pipeline to the more valuation insensitive big firms on the coasts so that you can bump up your paper returns and hopefully your ultimate financial returns on exit?
Think that coastal firms coming in is a great validation point. The valuations do tend to be higher, but in my experience, these intermediate valuations at the Series A, Series B, whatever, it's fine. It's a good leading indicator, but we are definitely trying to optimize for value add investors that can help us get to the next stage. And that's what I always tell my founders is don't optimize for valuation, optimize for the best partners, because an extra 10, 20 million bucks of valuation, it's a great ego metric, but it's not necessarily going to help you get to the end goal, which is money in your pocket. And it takes so long in this business to get to a real outcome. And some of these indicators are directionally valuable, but they're not the end all be all. And so if you really optimize for creating long-term value, then that's where I think you can really win.
Yeah, that's a great point that has come across in other episodes too, that it's really about choosing a partner that's going to be there for the long term as well, and not just for this funding round. And to your point, the highest investment doesn't always win over time.
Right.
Why were you willing to stick with the founders for so long at the beginning before making an investment? It sounds like you didn't just say, I met with them once, maybe twice, and then moved on. You kept up the relationship. What made you do that? I think that's a question that a lot of founders have. And even angel investors are wondering, if I don't make a decision in 1 hour, should I keep talking to these folks? So what made you keep talking to these founders here for Converse AI?
It's an interesting question because I don't do that with every meeting that I take. There are some meetings where you're just like, oh man, I think this team is onto something and I really like them. And ultimately, if you can be helpful and you can work together, you can see them operate over time and ultimately build conviction on what they're doing. The other question to ask is, how many of these teams do you do that with that never end up in an investment? And I think that it's probably 1 out of every 10 that we follow for that type of process ends up in an investment. Sometimes we're wrong and the company goes really far and then it's too far along for us to make an investment. Sometimes they never end up getting to the right end market or something like that. But our average time from first meeting to investment is around 6 months. The longest I've tracked someone in my career before investing is 4 years. The shortest is probably like a month and a half. I've never been one to jump at a first meeting, write a check. I think there are plenty of people who do that. I'm not one of them. And I like to get to know people because ultimately at this stage, I'm investing in people.
That's really helpful for you to paint the picture of the timeline. What's happening across that time when you have first met a team, there's some interest, and you're getting to know them? Is there consistent meetings? Like, just paint a picture for what it would look like if someone pitched you over that 6-month period.
Yeah. Oftentimes, if we think that there's something interesting there, we will try to put them in front of a bunch of customers and really figure out, is there something here that people are willing to open up their wallet for? And sometimes it's, oh yeah, I would love to do that, but we need these X features. And then the founders go back and build a little bit on that vector. Or sometimes it's, we really like you, but we think you need a really strong technical co-founder, and we'll help you go recruit that. And so we'll introduce them to a handful of technical co-founders. It's everything under the sun. Sometimes it's just, hey, let's meet up every couple of times. And we never say you have a good business. We often say, here are the points of risk that we see. And if you solve that point of risk, which maybe I've never seen a company solve that point of risk in 15 years, but there can always be a first time for it. So we never try to say, we know exactly what's going to happen here, but we say, this is the point of risk that I would want to de-risk in order to move further on an investment.
I have a question for Shahroz here. When I was investing, I feel like I was trying to be that type of investor where even if I was not actively investing in you, I wanted you to reach out to me if I could be helpful. And just because I like being around founders and startup ideas and seeing companies kick off. And no one ever took me up on it, especially when I was like formally at a firm. So Shahroz, did the same thing happen to you? And is there anyone else who says this and actually lives it? Because like Rajiv, I can think of one or two other people in the Valley that maybe are that way, but I don't know. Maybe I'm just really out of it.
Yeah, I do offer that for a team that I feel like I can add unique value to. And there's actually 2 or 3 in the last like year where I've done that. So it's not every team, just like Rajiv. And 2 of them have come back looking for perspective, advice, intros, and I absolutely supported and helped them. We did, by the way, specifically say, no, we're not investing. But the follow-up was, we're not investing, and I really believe in what you're doing. It's just not a right fit for us. Feel free to get in touch. And yeah, to my surprise, 2 out of 3 have come back. It makes sense to me that sometimes they wouldn't. It could be a little bit of a psychological block for them to come show up, as opposed to, I don't actually think you're valuable. But yeah, Amir, tell me more about your experience.
Well, there's 2 sides to it, right? I know having lived the founder life, that you'd sometimes feel not ashamed, but more fuck you too. I don't need to spend time with you. You already said no.
Yeah.
And so I'm going to go spend time with the people who said yes, or the people I need to cultivate into a yes. So that's one side of it. I think the other part is just like all of our times are valuable. And
yeah,
how do you allocate time to maintaining this relationship with someone, right, that isn't necessarily going to have a return while being genuine? And I feel like I would genuinely say to some teams, no, really, I like what you're doing. Please keep me up to date. Let me know what's going on. And the best result I would get is I would be put on their mailing list for like potential investors. But no one ever said, sure, I like the way you think. We had a really good conversation. I'll just keep coming to you once in a while. And maybe that will lead to an investment down the road. So I feel like, Rajiv, you figured something out there if it's actually working for you in Austin.
I think there's a couple of things that kind of work in our favor. One, it is a small market, and in Silicon Valley, you could probably just stumble onto the next investor and create maybe a relationship that's closer to a transaction. But the other thing that I will say is that the way that we view it is it may not result in a transaction for that company or that opportunity or whatever. But because we've been doing this across a couple of decades in Texas, I used to tell all of the junior people at my old firm that came in, even if the company is not anything that we'd ever invest in, if it doesn't look like it's ever going to go anywhere, just leave people with one helpful thing, whether that's an article that they can go read or an intro that you can make or whatever it is. If you do that consistently over a long period of time, you will end up, in my opinion, with a good reputation, and a decent reputation in a small geography, I think, is ultimately what we're trying to build.
I like that. Something for me to think about considering. That's great. Thank you. Let's move on to the last question. Amir, do you want to tee it up?
So again, you've been referencing Clutch a lot. Why don't we end with what you're excited about today? What are you working on? Can you give us more details about your investing strategy and the firm you've built and are building? We'd love to hear just the brass tacks of what's going on now.
Yeah. The amount of people that have moved to Austin, the amount of incredible companies that we're seeing right now at pre-seed especially is just incredible. So we are buried in super high quality companies right now that we are potentially looking at. One of the other things that I'm super excited about right now is a program that we're working on for company building. So we are working with a handful of teams, some that we've backed before, some that we've known for a long time, on basically diligencing ideas with them. And if it works, we'll write the first check basically on that slide deck. I'm spending a decent amount of time doing that in addition to our typical pre-seed investing. But we just wrapped up fundraising in Q4. We are incredibly excited about the opportunity. We have tons of capital to go deploy. And I think this is going to be the best fund of my career. And I think this year is going to be the year of the best opportunity in my career. So I'm just super excited about what's ahead of us.
You referenced earlier that you like to take market risk. So as you think about what you're excited about today, what are some of the markets and opportunities, white spaces that you are actively looking to invest in right now?
So we're spending a good amount of time in fintech with basically the amount of fraud that's going to be enabled by AI, generative AI. We are pretty excited about some opportunities in that space. We are looking at a handful of things in GovTech. Austin, that's one of the sectors that we're pretty good at. Not something that I've done a ton in, but there's a couple that look really interesting. Marketplaces, there's some really interesting marketplaces that are getting kicked off right now in Texas, especially with some stuff that in the areas that we're really good at, like oil and gas, that we're pretty excited about. And there's just a lot in a lot of different areas that gets us excited. But for the most part, I'm just really excited about the available talent right now because it's like nothing I've seen before.
So go ahead and tell us more of the specifics about Clutch and the sizes of checks that you write.
Yeah. So Clutch is a pre-seed and seed stage fund focused on Texas B2B software companies. We write a typical check of $500,000 into a $1 million to $2 million pre-seed round. We get very hands-on with our portfolio companies and really help drive them to the point where they're ready for follow-on investment. Our smallest check that we'll write is $250K into basically a slide deck. Our largest check that we'll write is $1 million into a $3 to $5 million seed round. But where we believe that we can have the most impact and where we're seeing a ton of opportunity and where not a lot of people are operating is really in this pre-seed $1 million or $2 million round size, where we feel like we can really punch above our weight. We have a handful of venture partners and a bunch of advisors that we bring to the table and really help our portfolio companies operationally. And we have a number of later stage funds that are investors in our fund, as well as deep ties to funds on the coast where we can really, if companies start to work, we can help guide them to the next round of financing. So what we ultimately want to do is we want to be the firm that is the go-to for entrepreneurs looking for pre-seed capital in Texas.
Do you think that exists today in Texas? If I'm in Houston and I come up with an idea, is there some place is there a default? I feel like when I was in Austin, it was still, I should go talk to Sequoia and Kleiner Perkins at the time. Like the big name for the firms that I knew about were the ones out here, and like maybe Austin Ventures once in a while. Is there a place to go if you're a funder? If you are a founder right now in Texas?
For that initial check, the first capital in, it's pretty hard. Once you want to get that $3 to $5 million seed round, there's lots of capital here. And then as you get into growth rounds, tons of capital. We have a handful of firms that have been really filling that gap over the past few years with bigger fund sizes starting to drift later stage. And so that's really why we started, is to address that opportunity.
So it sounds the goal for you is to be like, if I'm a founder in Texas, I come to Clutch first and then go out from there to the other main firms that are in Texas to go on and do like my seed round and my A round. But you want to be the first stop for any founder who's listening right now.
Absolutely. And if you go to one of those later stage firms, we think that you'll likely get redirected to us as well.
So besides more reps, how do you get better at investing?
That's a good question. I don't think there's anything that's special about my skill set or any particular investor, at least with this strategy. I think the reason that we're pretty good at what we do is we've just been doing it for a really long time and have been seeing a ton of companies over the past couple of decades. And we can use that pattern recognition to hopefully help founders avoid some of the traps that we've seen in previous companies, previous years.
In 10 years, you're on the Midas list. What got you there?
I think that means that there started to be some amazing companies, some multi-billion, $100 billion companies coming out of Texas. We want to be in the best deals in Texas. And if we do our job over the next 10 years and we happen to catch one that gets to 100 billion, that's probably what's going to get us there.
Okay. So this is related to something you were talking about earlier. Do you think that the LPs out there who invest in venture capital, private equity would see you as a hedge against the coastal firms then? That if they have a VC firm in the portfolio, that they should consider you as, in case the big outcomes start happening in Texas, that they should be putting money into you? This is not financial investment advice. We're just talking about this to shoot the bull.
I think that if I do my job, I give LPs exposure to the early stages in Texas. And if they believe that there's an opportunity to create outsized returns in Texas, then I think we're the team to do it with. I think that there's plenty of people in Chicago or Seattle or Miami that could make the same argument. I happen to believe in Texas, but so yes, I think they could view us as a hedge. But you probably want, if you're going to run that strategy, you probably also want to do some of these other geos.
Okay, speed round questions. You can keep it to one word. You can go on further if you want. Who is another first funder you admire?
I feel like a little bit of a cop-out is my partner's been doing this for 30 plus years and he knows everything about ventures. So I learn from him every day. But I'm going to say, and then the other great one is John Doerr and some of the other amazing folks that have come out of our alma mater. But I'm going to say Mike Maples. I think he pioneered this style of seed investing. He's an Austin guy. We were on a board together. I learned a ton from him then.
Okay. What is a book or a piece of media that has had a major impact on how you invest?
I don't know if it's a major impact on how I've invested, but I really love this book. And I'll tell you why. It's called Empires of Light. And it's about the AC/DC wars in whatever that was. And the thing that really struck me when I read that book, one, as an electrical engineer, I loved geeking out on the science, but two, they were entrepreneurs just like the software entrepreneurs of today. They were thinking through all of these problems about adoption. They were thinking through like the merits of AC versus DC, and DC was actually the incumbent and AC ultimately won. Anyway, it's a fascinating story, and I think it's very instructive. It's the same lessons over and over again. It's really good business lessons.
I'm an audiophile, so when you first said that, I thought you were talking about the band AC/DC.
Also, yeah. Also love listening to AC/DC.
I was like, an epic story about the band. Wow.
What do you expect from a Sid Rich guy?
Yeah, exactly. Will Rice, is that right?
I was Will Rice, yeah.
Yeah, okay.
All right, next
Speaking
one.
of which, okay, hold on. I do want to tell one story. I was thinking about saying this for the first investment that I wish I had made was in 2000. I was maybe a sophomore or junior, and there was this, and I was doing like signal processing stuff, like just a bunch of math. And then there was this guy who was like, what would be cool to make as an MP3 alarm clock. And it was the first thing that to me was like, oh man, you can actually use the stuff that we're learning to build cool shit. And I don't know if you can guess who that guy is. Javier.
Yeah, that was one of my senior projects. So
it was
incredible. I think probably like 2001.
Yeah, like who thought of that and who built that back in 2001?
It didn't work very well. The next speed round question is Zoom, phone, or in-person meetings?
In person all the way. I try to get in person as quick as possible, even on first meetings.
Wow, that's awesome. Social media platform of choice.
LinkedIn for useful stuff, Instagram for lurking.
Wait, what are you lurking?
I'm just catching up on what friends are doing. For time waster, that's what I do, scroll through Instagram.
Okay. I thought there was a different strategy I didn't know about. Okay. Thank you, Rajiv Bala. Where can people find you?
Our website, clutch.vc, LinkedIn. Feel free to message me. I'm usually pretty responsive there, but those are the best ways.
Dun, 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 dun. Thank you so much. Ba-boom.
All right. Thanks to Rajiv for that episode. So Showers and I are going to go over some of the key takeaways that we had after talking to Rajiv. I think for me, the first big thing was that there's clearly a Texas mindset and a work-life balance set of options that are different from what we see here in Silicon Valley. I'm not really sure if you can even like transplant that information and bring Silicon Valley to Texas or Texas to Silicon Valley. I don't know if it would do anything. And I don't know if that should affect how you think about outcomes in general.
I agree. It really shouldn't affect how you, as an investor or an LP, think about outcomes. And I agree. It's clear. There is a Texas mindset that is different from the Silicon Valley mindset. And I think that's true of other tech hubs like New York or Seattle or London or Toronto. Each region has its own unique set of inputs, culture, and mindset that help to create an ecosystem for innovation to start and thrive. And what's unique about Silicon Valley, it's obvious. It's very dense here, dense with all the right inputs, talent, investors, mindset, culture. And that creates a network of people that are all in 24/7 into this idea of building big companies. There's obviously advantages and disadvantages to Silicon Valley, and we're often told that we're in a bubble, and we are. That's what it creates. Having said that, we all know that plenty of companies have successfully started and reached unicorn status outside of Silicon Valley. But what I think is important for that to be possible is the village, is the ecosystem, right? Companies need more than just themselves to succeed. Talent needs to collide with the founders need to collide with the investors, and everyone coming together with a culture that embraces risk and ideation and creativity. All of the pieces of what makes a great ecosystem help with the journey of reaching outsized outcomes in a process that is inherently highly risky. And so I'm excited for Rajiv to play a role in continuing to foster an ecosystem in Texas, because we all need more companies to be started. And that should not be limited to Silicon Valley. That should happen anywhere and everywhere where the people are committed to creating that culture, that mindset.
My second big takeaway is that you do make your money on portfolio construction. We've heard this multiple times, and Rajiv brought it up. He's had experience with helping to see a venture capital firm go from tens of millions under management to over $500 million. And then he's also doing it from scratch right now with Clutch. And it seems like there's a financial calculation here that I don't really understand. And it would be good to dig into that more. Sharos, have you seen anything around this, like how to think about portfolio construction?
Look, I'm still learning too. I believe the first question is, what is your fund size? It's easier to return a small fund than it is to return a large fund. It just means that the outcomes from any singular company needs to be some multiple that's larger than the total size of your fund. So for example, if your fund is a $20 million fund, and when you have a company have an early exit in any price range of 50 million to 500 million, that really works well in your favor. But if you have a 2 billion fund, you can see how the fund size really dictates what kind of outcomes you're looking for. But irrespective of fund size, there's still some baseline diversification. The fund size gives you some clarity on how to then take decisions on how many bets, what are your check sizes, how much do you reserve for follow-on. That's portfolio construction. What I'm learning is that you try to have at least 20 to 30 shots on net, 20 to 30 initial investments over the course of 1 to 3 years of investing, so that you have the chance at having a few outcomes in that 5 to 7 to 10 year time frame. And then there's a delicate balance, because sure, the more investments you make, the higher chances you have of hitting some outsized outcomes, but then you're limited by your fund size. So the amount of ownership you have isn't as big. And so it's like a delicate balance and dance. It's obviously different for every firm, every fund, but there are tried and true methods. You're ultimately trying to have a diversified portfolio so that at least 1 to 3 of them lead to outsized outcomes.
My third big takeaway is one that we've heard before too, but Rajiv really brought it home, and that's there's no such thing as a sure thing. I think any investor who's had some experience going, at least 5 years is going to have encountered a company that they thought was the thing. They totally thought it was going to work out. It was easy money and it didn't work out. I think Rajiv's story about his worst experience hammers this home. And I think it shows that, in the end, no matter what, you are placing a bet. Sometimes the bets are a little bit better, but your expected value on these should be zero.
Yes, I think as an angel investor, you might want to keep your mindset that these will most likely go to zero. I would say, though, it is better thinking about your entire portfolio as an angel if you're able to make 20 to 30 bets in some, say, 2 to 3 to 5 year time frame and expect some returns in that sort of 5 to 7 to 10 year time frame. But if you're sprinkling one bet here or 3 bets there, yeah, I would say statistically speaking, the chances of those coming to fruition, especially at the early stage, are low. I think the mindset is different for an angel. However, as a VC, we are constantly monitoring our portfolio and trying to be realistic about the underlying value of the company and the portfolio at any point in time. Sometimes we'll proactively mark things down to zero, and often we keep deals at their last valuation until there is a reason to mark up or mark down. The VC mindset is certainly looking at the entire portfolio versus singular bets.
My last big takeaway is one that I still just don't know how to do, and that's that nurturing relationships is key. I honestly don't know what that means. I think, I have a hard time keeping up with friends and family. I don't know how you do that with founders in a business setting, besides setting up calendar entries. And even that feels impersonal in the end. I know I've interacted with venture capitalists and investors when I've been on the founder side of the table, where I feel like they are doing a great job of being warm, friendly, keeping me in mind as they do their thing. But I don't know how they do it. I really don't. Do they just have an incredible CRM system? Do they have an assistant that is magical? I don't know. If I could figure this out for myself, I think I'd be much more successful as an angel investor. How about you, Shairoz? Did you get any key tactical takeaways on this point?
That is funny. Yeah, I think this part is natural for me. Well, I would say it's part natural, and I do have a light system around this. The natural side of me is that, yes, often in the course of my week or my month or my day, I make it a point to be in touch with friends, founders, or other investors. Yeah, calendar entries are effective, actually. Sometimes I do have to schedule even a casual hello to someone. It's not always reaching out because I need something or they need something from me. Sometimes it is literally just checking in on how you're doing. And I find text message and voice messages to be really effective tool for this. But in terms of, am I keeping on top of people through some sort of tool? I think I could do a better job at it. But what I do have is this Excel list of people I like to work with and people I'd like to work with. And I just sort of scan it, I would say, I don't know, maybe every 2 months or every quarter, just to check in. Have I been in touch with this person? But overall, it is sort of natural to me and often part of the job, right? You're thinking about problems that founders have and thinking of people you might know that might be able to solve those problems, or the founder's fundraising, and you have a reason to reach out to your investor friends. And so I find that the problem-solving opportunities lead to a reason to reach out to someone, but I do it naturally and just wonder how people are doing. So look, I think for you, something to think about is, if this isn't natural to you, I think you could set up a CRM like Affinity. It could be a really great way to let you know when you haven't been in touch with someone who is important to you. And I feel like that's something that you could really just be okay with outsourcing to the machines and have them do the hard work of telling you who to connect with and when. So that's my tactical takeaway for you that you might want to try out. I'll just add 2 final takeaways. Our conversation about selective incubation that Rajiv does, where he works with a team for 6 months to a year before writing a check. I really love that. And I wish we could always do that. But again, time is limited. And so I wanted to share how I do it. I notice it's probably been 1, 2, maybe 3 teams maximum in a year where I stay in touch with the team at a really early stage until they're ready for their pre-seed or seed. And what I noticed is it tends to work well with either a founder I already know for some amount of years, and so we have a natural reason to be in touch. We're kind of friends. Or it's a new founder to me in a space that I know well, so they have a reason to reach out to me. I can give them perspective on the space, or I know people in the space. And so I do think that there's so much value in getting to know someone over a period of time. As an investor, it gives you some asymmetrical information before you make that investment. So yeah, I think it's a wonderful way to de-risk investments. If you do it selectively, it can work within the busy schedules we all have. The last takeaway I'll share is just the very touching one that Rajiv shared in the beginning, how early in his career he had to step into one of his portfolio companies and manage the shutdown, and how humbling that experience was, and how that experience of operating through real world experiences created empathy for the journey. And I think investors do benefit from these experiences, whether they are stepping into a portfolio company or they are a former operator or founder. There is nothing like understanding the human side of building a business. Even if we are building technology, in the end, humans are coming together, they're believing in something, and they're taking risks together in a way that doesn't happen in a corporate setting. And so I think there's a huge advantage when investors can speak to that experience and have empathy, and then be helpful in some of those challenging moments. That's all from my side.
All right, that's what we've got for this week. I will talk to you soon. Bye, Shahrose.
Thanks for listening. We'd love your feedback and suggestions on topics and guests. You can find us on Twitter X @Shahrose and @Avarani.
Subscribe to our newsletter to get behind-the-scenes access, learn more about the guests, and receive the key takeaways from each episode. You can find it at firstfunderspod.com/newsletter.
And don't forget to subscribe and share with your friends at firstfunderspod.com/subscribe.